Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so we had a lot happen to start the third quarter. After a big run-up in the markets to start the year, things seem to have settled down in July as the market was expecting a Fed rate cut. I think a lot of people were hoping for a 50 basis point rate cut, but the Fed only gave us 25. I think the bigger question here is why did they cut and what can we expect going forward? First off, if you remember what I said back at the end of 2018, I felt like the Fed went way too far too fast. Not only did they raise rates 9 times, taking the rate from near 0% to 2.5%, but they also unwound nearly $1 trillion of their balance sheet. That's a lot of tightening of financial conditions. I think this rate cut was more of an insurance cut that basically reversed the 25 basis points that they raised in December. If you paid attention to Powell's speech after the cut was announced, it sounded a lot more like, oops, we shouldn't have done that rate hike in December, so let's just take it back and justify it. I realize the Fed pointed to the uncertainty of trade negotiations as another reason to cut rates, but the Fed bases a lot on economic theory, and there really isn't a playbook for what the real effects of these tariffs are going to be on the overall economy. I think they're just using this as an excuse for going too far with the rate hikes. Another thing to remember is that the global economy is slowing. This is why I was surprised to see them cut or hike rates in December. Outside of the U.S., things just aren't as strong as they should be. And finally, we live in a global economy where capital can move pretty easily around, and the Fed needs to keep their rates competitive with the rest of the world. Whether you like it or not, it appears that all central banks around the world are quite happy with free money and very low interest rates. So let's take a look and see what may happen going forward now that the Fed has cut rates for the first time since the financial crisis. Look, the markets are very aware that the Fed was going to cut rates. Markets like low interest rates, but let's see what can happen when the Fed starts an easing cycle as it relates to the market. Here we have a chart dating back to 1995. The black line represents the effective Fed funds rate, and the green line is the S&P 500. The red line shows when the rate cuts started. And here on January 3rd, 2001, the Fed began a rate cutting cycle, and as you can see what happened to the S&P 500 in the next couple of years. The same type of cycle started on September 18th, 2007, and we all know what happened in 2008. So let's kind of zoom in on the last 2 rate cutting cycles to see what kind of performance the market had about a year later. Here we have the performance of the S&P 500 index that starts on January 3rd, 2001, the first cut of that cycle. And as you can see, the market reacted quite positively, jumping about 5% 1 month later. But the next 6 months were a different story. After the initial jump, the next 6 months saw a sell-off of about 10%, and a year later, the market was down about 9%. Looking at the rate cut cycle that started in 2007, we see a similar story. The first month experienced a jump of about 4%, only to see the following 6 months sell off to the tune of about 10%. 1 year later, we saw the market down about 18%. Now, I realize that this sounds like doom and gloom, but before everyone gets too nervous, there was an exception. In 1998, the Fed cut rates on September 29th. And interestingly enough, the market initially sold off pretty hard, only to rebound very quickly and ended the first month higher by about 4%. 6 months later, the market continued rallying another 28% and ended 1 year later up about 21%. So what can we glean from these charts? In 1998, the Fed only did 3 rate cuts in response to weakening global economic conditions. At the time, the FOMC actually said, and I quote, "The action was taken to cushion the effects on prospective economic growth in the United States of increasing weakness in foreign economies and of less accommodative financial conditions domestically." Sound familiar? Well, the Fed went on to start raising rates in 1999 and reverse basically all of the Fed cuts. So what is it? What's it going to be? Can we expect the market to sell off, or should we expect it to rally? This is the $1 million question. Remember, the Fed typically cuts rates when they're concerned about the economy and need to spark economic growth. If the economy really is weakening and a recession looks likely, then I think we get a 2001, 2007 type of market. That said, I don't see a recessionary pressures building right now, and I think this rate cut was simply a reversal of the December hike, as I said earlier. Maybe the Fed will do another cut this year, maybe not. But if people are worried about a recession, I just don't see it right now. Are the markets going to get more volatile? Yes. Did the markets price in too much additional accommodation? Absolutely. Will we have a pullback before resuming the uptrend? I'd be shocked if we didn't. The markets, sometimes they act like spoiled children. When they don't get what they want, they tend to throw a hissy fit, and that's basically what we're seeing the markets do right now as I'm doing this video. Add to that the recent comments about applying the additional 10% tariff on the other $300 billion of Chinese goods, and it should be no surprise to anyone to see that the markets are under pressure. Okay, so let's take a quick look at what the markets did in July and what they're doing for the year. Generally speaking, July was fine. The S&P was up about 1.3%, and the Dow was up about 1%. They're both up 19 and 15% for the year, respectively. Looking at sectors, cyclicals were the best performers so far this year. Communication services, consumer discretionary, and technology are all up over 22% for the year. So all in all, just so far a pretty good performing market. Turning to fundamentals and my 4-part framework, these are the 4 major components that I look at when I'm making investment decisions over both the short term as well as the long term. So let's just take a look at each of these independently. As far as the economy is concerned, it's pretty much the same as last month. I still consider us in neutral territory, not too hot, not too cold. Economic numbers are strong. Employment is strong, at least as far as GDP is concerned. And clearly there's no signs of inflation. With the Fed cutting rates, even by the small 25 basis points, I think the economy should continue to do fine. Looking at earnings, second quarter is looking pretty good. I've upgraded the earnings from last month from negative to neutral this month. Of the companies I've reported, it looks like about 75% of them have reported a positive EPS surprise. Estimated earnings are down about 2.7% year over year, but they were expected to be down over 3%. So this is a little bit better today. And the numbers are looking a lot better for companies that aren't dependent on overseas revenues. In other words, companies that are doing more than 50% of their sales in the U.S. are reporting much better numbers. As far as valuations, they've gotten more expensive, obviously, with the market rallying in the first 7 months. They're now above their 5 and 10-year averages, and forward Ps are about 17. It's not astronomical, but they're not cheap either. And given what's going on with the trade negotiations with China, there is a little bit of risk there. And finally, markets made a big bet that the Fed would save the day. Given the comments by Powell, it appears that the markets aren't quite happy with what they can expect from the Fed in the coming months. Last month, the pendulum swung to greed, and with the latest threat of additional tariffs on Chinese goods, it looks like the pendulum now has swung back to fear. I'm neutral here because I still think that market participants are buying the dips, so any pullbacks can be supported and should be short-lived. Where do we go from here? I don't think the 25 basis points are going to have any meaningful impact on the economy. This cut may be followed by an additional cut, but really until we see some real deterioration in the economy, I wouldn't expect the Fed to be much more accommodative and inject much more stimulus going forward. Last month, I mentioned that the expectations of a Fed rate cut, investors would be very eager to jump in with both feet, but I also cautioned not to chase returns. I still think that caution is warranted, and better opportunities will come around in the coming weeks and months. Bonds are not cheap. They're telling you a different story. They're telling you that the economic growth story isn't as strong as some people think? Or is it that it's just worried about the trade tensions and the Middle East tensions? Are those issues causing a flight to quality? I think it's a combination of basically everything, of all those things. Only time's going to tell, but I do know that with yields this low, bond investors need to be very careful if things reverse and we start to see a spike in interest rates in the coming months and years. And finally, last month I talked about the risk in the market and that there could be a situation where you want to buy the rumor and sell the facts as it relates to the Fed rate cut. Defensive positions and cash hurt performance a bit in June and July, but it's certainly helping now in August. And if you have some dry powder, I think there's going to be a better opportunity to buy stocks when they go on sale. How big that sale is to be determined, but it will be a sale nonetheless. So thank you all for watching. I hope this video was helpful, and if you have any questions on anything in this video or you just want some more information, please don't hesitate to call or email me. Thanks again. We'll see you next month.